Hi, this is Randy Finney with Right Side of the Chart, and today's Thursday, January 7th, 2016. In this video, we'll take a look at the biotech sector. The biotechs are once again one of my favorite sectors for 2016. In 2015, for those of you new to the site, I put out a video back on July 30th. You can reference that on the site. Just use the search function and search for biotech rec pending. And in that video, I stated the biotechs as at the time that I was expecting a drop of at least 20% with emphasis on the at least. And that's what we got. We had about a good 30% correction. Really from that point on, the timing was spot on. And so were the targets. If you look at, we're looking at XBI here. One of the charts I covered in that one was IBB, stating at the time, if you go into that video, about the 8-minute mark, I stated, when we were up here at the time, before we had broken down back in July, right at this point where the finger is, I said my expectation was this blue trend line, this uptrend line here in IBB would be hit in the last week of August, and I actually had the cursor on that August 28th week, and that's what happened. So we, both the expected move and the timing worked out, and as I stated, we did get that healthy, much more than a 20% drop. And the reason I'm doing this video is we've come full circle. I reversed on the day the biotech's bottom. That was all posted. You can reference that. Went from short to long. I did leave on the LABU long and stated for longer term traders, you have the decay, especially in a volatile sector like the biotechs. That's why my preferred trading proxy, as far as ETFs go, was and is LABU, the 3-time long. Here, we'll just take a look at that real quick. LABU, it's the 3-time long biotech ETF. Biotech bull. So not only are you getting the price movements, that was back, here we were when I did the video back at the time and put that on as a short trade idea. It was the last week of July, so right about here. And if you take this measuring tool, you can see that that's already dropped about 70% so far. I'm sorry. Is that correct? Yes, 69. It's in the red on the bottom, 69.5%, according to the measuring tool. So what you're getting there again is the move down in the biotechs and more importantly, the decay. I won't speak too much into that now. I've talked about that quite a bit. If you check out the ETF page on the right side of the chart, there's an explanation on how and why that decay works, and I'll post a little bit more about that on the site. But either way, this is a kind of a tuck it away and forget it for longer term investors, that are, share my mindset that the market's most likely topped in 2016 or 2015, I'm sorry, especially the biotech sector, which I believe to be the case. And as stated, we went, personally, I covered my shorts and reversed and went to a bullish bias, traded the biotechs up. Literally right there, the day of lows. I'm trying to recall a couple trades in and out, and I believe I was long here again and got out. And now, not too long ago, I put those shorts back on a lot of the individual biotechs, and that's what we'll talk on today. We're talking on trading opportunities. I'm not going to focus too much on what happened back then. Let's take a look at what's going to happen from here. And we'll do this video relatively quickly if I can. Try to keep it under 20 minutes at least. This is XBI. Excuse me. XBI is a Spider S&P Biotech ETF, one of several out there. And this chart is basically the same chart with the same trend lines that I had in the video back in July. This was the trend line that I expected to be hit. You can see I had this what I call sub-uptrend line. I like to refer to these sub-uptrend lines, and this being the primary uptrend line, primary bull market uptrend line. So we had that breakdown there, and the selling was very impulsive. This was a reaction high back here in 2014, an area that I was targeting, and we hit that. And you can see how well, the biotechs are just, in my opinion, one of many beautiful examples of how well technical analysis can work, and how really fundamental analysis cannot even come close to predicting price targets, reversal points, when things will happen. There is a place for fundamental analysis, absolutely, especially in long-term investing. But when it comes to trading, the charts rule, and they're really the only accurate measure of where to enter and exit positions. In other words, you're short on a nice trend line break like this. You see we came down to maybe a hair above that reaction high on the February lows on XBI. We bounced, and that also came in. That's what I call intersecting support. When I see intersecting support levels, in other words, this uptrend line, and it comes in with this reaction high horizontal support, that is just very, very high probability you're going to have a reaction, meaning a pause and or a bounce off that level, at least on the initial tag. And that's what we did. So, nothing goes straight down forever. So the biotechs had a sharp correction, pretty much melted down with the market back in August, and had a snapback rally and then made another low, pretty much tested those lows. And from there, we had the first nice counter trend rally. And now here we are today, and this is why I'm doing this video now. Of course, we're first of the year is already upon us. We're into 2016. I didn't do a whole lot of trading in the last few weeks of the year, nor do I ever do. That's just from my experience, you just get ground up and with the low volume and all the volatility. So now we're back into things here, and so what I'm looking at. Before I started this video this morning, as of yesterday, the Biotech's the XBI, and I had mentioned this in the trading room yesterday, had closed right on that trend line. This is a very important trend line, well defined, goes all the way back to 2011, and as of now, we're trading through it. As I often state, if trading off the weekly charts, you want to see a weekly close. So the fact that the XBI has broken under this trend line, that is not really a sell signal, at least not by this metric. It's definitely not an all-in short sell signal. I want to be clear, I am bearish on the biotechs. I don't think there's anything wrong with being short here, but what you really want to see for confirmation is a weekly close, because it is not uncommon to see intra-week breaks below support levels when trading off these weekly frames, only to see the prices close back above. So that's what I'm looking for. So any additional downside, tomorrow's Friday, so if the biotechs continue to move down from where they are right now, we've taken out that weekly trend line. Now this will be our next support shelf, call it 58.50, somewhere around there. And especially because it comes in with those previous reaction lows and that reaction high back in 2014. And you can see down here, these are my next downside targets. I have this line here about 47.30. And ultimately, I think before all is said and done, we'll probably go down to this 38.23-ish level. A couple reasons for that, and those are horizontal support levels. I look at reactions. I can't explain right now in great detail how I come up with my support levels, but there's a lot of factors that go into it. One of those also being, I like to use this volume at price histogram. These thin zones often work as support and resistance levels as well. So first and foremost, I put the lines in on the price support levels, and just again from experience and intuition where I think prices will go based on this chart, and those happen to line up very nice with these volume at price histograms, which is usually the case. Fib retracements are always a great tool to use as well. So if we look at the bull run really off the lows back, the biotech's traded sideways for quite a few years, but if you look at the fibs here, let's see, zoom in a little bit. We have the 50% fib would be at this level here, and that is 50% or half retracement of the bull market, and that's not too much to expect, especially from the run-up that we've had in the biotechs. If we come down to the 61.8% retracement, we're down here around the 40, I don't have the numbers up right now, but 43 level. So again, my point is this would be just a run-of-the-mill call it correction, call it bear market if you want. Again, assuming that the top is in the biotech sector. Clearly, we've already had a bear market, at least by the conventional definition, which is a drop of 20% or more. I'm just making the case here, as I had all along, even before the initial drop, that I think there's, over time more downside to come. And like I said, I don't think as much as for those of you who are biotech bulls saying, oh my gosh, the XBI had already dropped from 90 to 60, there's no way it's going lower. Just take a look at any bear market in history on just about any asset class, and you'll see, a 50% retracement is not much. I mean, a lot of bull markets, or bear markets, I'm sorry, can retrace 70% or more of the previous move. So I just wanted to kind of put things in perspective there. Okay, enough on XBI. Let's just look at a few more. I know a lot of you like to trade the ETFs, especially in a volatile sector like biotechs. And not only are the biotechs volatile, but the problem with biotechs, more so than really any other sector I can think of offhand, is the fact that you have a lot of drugs in clinical trials, phase 1, phase 2, phase 3, pending approval. And what happens is you have a lot of hopes built up, and all of a sudden, out of the blue, comes results that the study's not going the way it thought they would, and the FDA shoots it down, doesn't let it clear phase 2, and boom, these stocks can drop out of nowhere. So unlike just about any other sector I can think of offhand, all the big gaps that you typically have to worry about, other than some spurious random news event, are quarterly earnings, and you can get out of the way of any stock because when the earnings dates are well ahead of time. They're announced ahead of time. However, in biotechs, with those phase with approvals and denials, or for lack of a better word, on the clinical trials, those come out of nowhere. Those aren't announced. And that's why trading individual biotechs, you either need to use, which I like to do, a shotgun approach, have several names. Also stick with the big names as well if you're going to trade the individual biotechs. If you're, take a look here, I'm going to go through some of these individual components. I have these ranked by market capitalization, and these are the components of the IBB. So you have Gilead, Amgen, Celgene, Biogen. Those are the mega caps, and you're not going to see 30-40% gaps. It would be extremely rare in these big names. However, if you go down to the other end of the spectrum, the smaller biotechs, here's one with $135 million market cap, ADHD, whoever that is, Alcobra Limited. So you get in a name like this, and well, there's an example. This is a weekly chart. Let's just go to the daily chart, take a look at that gap, see what happened back then. So here was a gap that lost 50%. Okay, so 47% drop. There's my example. You go with a small biotech. Now let's go back to large names, Gilead, and here's a daily chart. You go back to a weekly chart. You don't see any massive gaps, and that is because they're large, they're diversified, they have a lot of drugs in the pipeline, unlike these smaller, lower capitalization biotech companies that may only have one or just a handful riding, so it's make it or break it. Okay, enough on that. That is really, but I do believe that's important, especially for newer traders and investors. Know your sector, know your stocks, know the risks involved, and as I said, with biotechs, you have to be careful, especially with the little guys, because you do have those potentials, and the gaps can go either way. They can go to the upside. Maybe a company gets approval it wasn't expected, or better than expected clinical results on a trial, and it can obviously go to the downside as well. So let's finish up here. One more, PBE. I want to focus mainly on the weekly charts here. PBE looks, the primary downtrend line is quite a bit below where we currently are. On PBE, I covered that on the July 30th video. And at the time, these are my notes from that point in time. I was expecting at least a 24% drop. We got that and then some, quite a bit. This would have been a 24% drop there. So what I was looking at on PBE was short of the break of this bearish rising wedge pattern. Very clean, beautiful rising wedge pattern. As I said, there's very few sectors that have just such clean charts right now as the biotechs, and that's why they've been one of my favorite throughout 2015 and currently are, because you have these well-defined trend lines and horizontal support levels, and not to mention that the sector has just gone ballistic, almost parabolic in the last few years, and there's some extreme overvaluations in that sector. So that's a bubble that's already been popped, in my opinion, and has more air to come out of the bag. So anyways, we're looking at a consolidation period here. So we had the initial breakdown. This long stick, forget about that. That was sort of a mini flash crash just due to the computers and the bid and ask orders not keeping up. It did happen. There were trades that low, but I consider that somewhat of an aberration. In fact, I had puts on PB that day, and I can't even tell you how much they were up, like so many hundreds of percent, but I couldn't get a fill on them. I tried to, at least not at the price they were at that time, but I did get to close them out later that day at a less favorable price. But the consolidation here, this is what I'm looking at. So we had that initial drop, and this looks like a consolidation. And we'll go back to XBI, it shows a little better. You can see the consolidation there. This is a weekly chart. Here's a daily chart on XBI. This one might be a little bit busy, but that 73 was a resistance level. Quite a few reactions there. It was also a key fib retracement. What I did, well, let's take this line away. This is a little bit too busy. Okay, we have this. This is our fib retracement. So really from these lows back here, it's called a double bottom. We had the August lows, and then we came back here in September, late September, retested those lows. So I drew a line, I put these fibs here up to this reaction high, and you can see on the pullback, we stopped almost cold right at the 61.8% Fibonacci retracement. The fib levels are over here to the left. That's the dotted lines. And I also had a horizontal resistance line here. So XBI went up, had a typical retracement, and has since moved down. This trend line would probably look a little bit better like that. So this is what I'm looking at. It's almost flagging type action, if you will. You see this move up after the breakdown from this trend line, and now prices have broke down here. So this is the real key support level that I'm watching now. I should remove that 57.70, although I think it's a valid level. But these two lines here, really the reaction lows back from August and September. Once that goes on XBI, then I think there's more downside. And again, I'm focusing a lot on the long term, put a heavier weighting into the longer term chart. So if we make a solid close below this blue uptrend line, that has taken out our weekly uptrend line. Let's go to IBB, another big one. There's an almost identical primary uptrend line in blue, the bearish rising wedge, which we shorted back in July. We had that quick move down, and if you really zoom in, as I mentioned, this appears to be like flagging action. We had that move. These stocks became very, very oversold and very short term, short order that is. And as such, and they hit support, so we had the expected bounce, and you can see now that's how that flag would look. We are breaking below that flag, so let's see if we close below that this week, which we have a good chance. Here it is on a daily chart, zoomed in. You can see this uptrend line off the lows. We have 1, 2, 3, 4, 5, 6 reactions, so that's a pretty well-defined uptrend line, and now we've gapped below it today. So if you're not currently short the biotechs, this would be an objective entry because we've broken down from support. The next objective entry, if we move back up to back test this, let's say up to this level here, you could certainly add on there. Here's a fib retracement. You can see the blue line off the lows in August and September. And IBB stopped cold, or not cold, but just reversed at the 61.8 fib on that first attempt, came back up, hit that 50% fib retracement level once, twice, and has moved back down. So, I like to use these fibs in conjunction with horizontal support and resistance trend lines. I also mentioned back then in July. This potential broadening wedge pattern here. The yellow lines define the broadening wedge pattern. So we've got a ways to go. And I often mention the partial rises when you get those moves back in a broadening wedge pattern, anywhere up to the 50 or 61% Fibonacci retracement. And I may have already mentioned that on IBB as an objective short area when we made that partial rise into the wedge. I can't recall. So where is IBB headed most likely? Well, this would be our first stop here. When I have two lines close together, I refer to that as a support zone. So 278, the lower line, 283, so somewhere in that area, and that's really defined by those previous reaction lows, as I said. But when you go back in time, you see that prices, this was resistance back here. It was that peak or reaction high back in 2014. Prices came up, took several weeks testing that area, finally made a breakout. And once resistance is broken, it becomes support. So we had the breakout, strong move up into that bearish rising wedge, and there we're at. So this would be an extension. If we move down here and make a solid break below, let's say the 278 level in IBB, that will almost assure that we're going to continue down, that we're in an ongoing, a new cyclical bear market in the biotech stocks. And the next stop would be 250-ish right there, and I have a line here at 211. Let's just take a look at retracements. If we go back to when IBB really began this bull market that it's been in or was in for quite a few years, you look at fib retracements and you can see how that 38.2 fib comes in just under that that first target that I have there. And then again, if we were to make a 50% retracement, that would bring us down to this level. A 61.8 would bring us down there. There's actually some support there. You see a few reactions. So if I put a horizontal line here, it captures where we had this reaction. Prices broke through, came and back tested that level and moved up. So if I had to take a wild guess right now, is if we have begun a new cyclical bear market in the biotechs, where it ends in IBB, where I would be very interested in stepping in long, that would be down here around the 185 level. Okay, I ran a little longer than I wanted to, so I'll just rifle through some of the top holdings, as most of you who followed the site know I like to do when I cover the markets or a sector. I do like to look at the top holdings because the top holdings are usually the heaviest weighted components. So what I'm doing to the left of the chart here, I'll pull it over. I have a related items list, and I'm in XBI. So you can see here XBI. These are all the components of XBI. There's quite a few. So they're all here, and I like to rank these or sort these by market cap. So starting with the largest, and that's Gilead. I'll only go through a handful here. And what this does, it helps to confirm the picture. If you look at the top components and you can confirm a bearish case on those charts, then that only helps, validate your bearish outlook on the sector. However, if I looked at, let's say, a handful of the top components and they were still at or just above key support levels, even though the index or the ETF broke down, I may hold off and wait for those top components because those are usually, or they are the lead dogs. They pull the sled. So we'll start with Gilead here. Well-defined uptrend line. You can see that it's very steep advance. It's actually an ascending price channel if you look at the parallel lines here and here. And what we had is a breakdown back at this point and then a high level back test. That back test was a perfect back test to that uptrend line. Coincided with a divergent high. You see the white lines here, prices making higher highs against the PPO and the MACD making lower lows. Again, in technical analysis, at least as with my trading style, it just doesn't get any better than this. These charts are very clean, if you will, and very clear. You have multiple reactions, 1, 2 here. This was my first target during the pullback, and we hit that target almost to the penny, that T1 level. fib retracements are there. You can see, if you can make out the yellow dotted line, that was just above that 31.8 retracement. My next target down here, I have a horizontal support level at 64.75 with a 50% fib right above it. I have a horizontal line at 56.64, and if you make it out, you can just barely see it. It's right on the 61.8 fib retracement. I almost always put my horizontal levels first, my targets or support levels. Then I add the fibs, and it more often than not, those fibs will line up very close to or right on the support levels or resistance levels, if depending on which way we're looking at the chart. So let's move forward. That's Gilead, and so any break of this solid break of that T1 level, let's say the lower line, 84. Call it $84 to be safe. If I'm, let's see if I'm on the bottom one. Yeah, 84 would likely bring us down to the. It's about the 60, the fibs at the 68 level, and that price support level 65. So somewhere in there, 60, 65, 68-ish. Amgen, another beautiful chart. It just doesn't get any better than this. Well-defined primary uptrend line, divergent high, breakdown, target hit. This was support level. Again, a lot of these charts were covered in that other video. The initial counter trend bounce, as we always see, and if you're an Elliottian, you would say that's your wave 1 down, wave 2 up, and now the P3 comes, and that would probably take us there. The primary third waves are the most impulsive waves, and that would, just eyeballing that would look like a great and very likely target, that 110 area in Amgen. Nothing there on ABBV. I don't see a lot. Sometimes, I get questions put to me all the time on the site. I don't have an opinion on every chart, and if I don't, I move on. But so that's why I skipped over ABBV. Celgene, nice, same. Just like most of these biotech stocks, nice well-defined uptrend line, divergent high, breakdown, back test, and this is the level we need to take out here. Call it 106.60, 106.50 maybe. Once we take that down, you can see the other levels there. You can see the fibs on the chart. Biogen, nice ascending price channel, divergent high at the top, very sharp impulsive breakdown, hit that support level. Again, these should have been outlined in that July 30th video, and a couple bounces off there. And again, until these levels are broken, you need to be a little cautious, because trading 101 is you want to short a break of support. You want to buy a tag of support for a bounce if you're expecting a bounce, but to short right above a key support level is contrary to trading. So if you're not already short, like I said, if you're swing trading that LABU down, great, hold it, tuck it away. Especially if you're not an active trader, you don't want to try to game all the bounces, because it's going to shake you out and you may not get back in. But so if you don't have a position and you want to get short the biotechs, look at these levels, wait for these support levels to go, and that would be your next objective add-on. Okay, just a couple more here. REGN, Regeneron Pharmaceuticals. There's a primary uptrend line, and that would be my target. This is, again, I talk about beautiful charts. This one, you look at this long-standing, powerful negative divergence into the highs, breakdown, back test, and I can just see it in my mind's eye. This is how that stock is going to play out more than likely. Nothing is 100% in trading, so like everything else, don't put all your money in any one stock, any one sector. Use stops. If you were to short REGN, an objective stop level would be just placed slightly above the recent highs right there. So from an RR perspective, a risk to return perspective, you short the stock here, you have, let's say, that's about a 15% upside, and you just have to adjust your position size for such a large stop. yet you have a 46% downside to that target. Actually, it might go all the way down to the trend line, 45 to almost 50%. So from an RR perspective, that is objective. However, I've stated shorting a lot of these stocks more recently up here at the highs when we had that bounce. I'm not crazy to load up on short exposure at this point in time. The more objective move was on the bounce back to resistance. So let me stop it here. This video's gone on a good 10 minutes longer than I wanted to. But if you have any questions on any of these individual stocks or the sector, shoot me an email, use a contact form. I also plan to put some individual names. I'll continue to comb through the biotech stocks and pick out my favorites because I personally like to, in addition to shorting the LABU, I do like to take a shotgun approach and spread out some individual shorts because I can often, if I get the call on the sector right, I can often pick the most bearish or bullish stocks if I'm going long within that sector and greatly outperform whatever the sector is doing. In other words, if the biotechs are poised to drop another 20-30% from here, I can all but assure you there's going to be handfuls of stocks that do 50% or more, and those are the ones that I look for on the individual trades. But again, trade according to your own risk tolerance, trading style, and although I can't give investment advice, I would say to those of you that are new to investing and trading, you're probably better off sticking with ETFs until you get up to that comfort level to short individual stocks. Okay, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed.